Yeah, first of all, I'd like to thank you, O&M, for allowing me to hold forth here on an area that I know a lot about. I think you watch what the stock market is doing, you watch what the dollar is doing, and you watch the price of gold. I actually think the best indicator of how fast the system is coming unglued is the gold price. I mean, you know, everyone says, well, is the dollar strong, is the dollar weak? Well, it depends against other currencies, and they're all fiat currencies. So I don't really view that as the most important measure. I think that, you know, when the gold price takes out 1900, which was the old high from 2011, and then starts pushing into the twos and then passes 2500, you know, more and more people are going to say, hang on a second, there's something going on here. You know, maybe this money isn't holding its value. Maybe I need to have some of that gold. And then it passes 3000 or 4000, and you know, you kind of get what I call, or what is described as Gresham's law, which is good money shoves out bad. And so people realize their savings are losing value and that they ought to be saving in gold, and it's going to shove the demand for gold up. The other thing to watch is the bond market and the Fed balance sheet. I mean, this only works, you know, there is more inflation than they say there is, and this only works if they're able to keep interest rates low because of all the debt. I mean, all the debt is so large that if it were to ever be marked to some kind of real market interest rate, you know, the entire world would be bankrupt. And so as a result of that, they have to keep interest rates low. And right now, the bondholders are kind of anesthetized because they know the Fed has their back, and they know the Fed will buy whatever bonds they want, and they don't see a good alternative. I mean, there is no alternative other than maybe the stock market. Maybe that's why the stock market's held together. You know, the Zimbabwe stock market did well in you know, nominal terms, not real terms. So you know, I think what will happen is eventually what you'll see is the bondholders will say, hey, hang on a second, you know, I got to get out of this thing. This is yeah, they'll pay me back nominally, but that's not going to have any value. The inflation that's coming, the debasement is real. I got to get out of here. And they'll say sold, you know, and it'll be a government bond, and they'll sell it, and there'll be no buyer, you know, or certainly there'll be no buyer at, you know, 70 bips on a 10-year treasury. And so, you know, it'll be sold to you, Fed. And then the Fed will have to put it on its balance sheet, and then that balance sheet will start going up. And I've described this in my quarterly letter, which I'd be happy to send anyone who wants to see it. But you know, basically it becomes a doom loop. So you know, the bondholders say, "Oh, there's inflation. I'm going to sell my bond to the Fed." The Fed says, "All right, I got to keep interest rates down, so I got to buy that bond, or else you know, interest rates will go up." I mean, bond prices down, interest rates up, or bond prices up, interest rates down. And so the Fed steps in to buy it. The Fed balance sheet grows. You know, that growth represents monetary debasement, and then people say, oh, you know, it's getting worse. I got to sell more bonds. And then pretty soon, you know, the end point can be some sort of very serious inflation, or perhaps even hyperinflation. I mean, that's in the Weimar case, that's what happened. It was a very similar setup back in Germany in 21, and it took 2 years to unfold. I mean, by November of 23, you know, the old Reichsmark was worthless. You know, it was wheelbarrow money. So. Which is why, by the way, the Germans until, you know, more recently were the firmest in terms of trying to be monetarily sound, because they had grandparents who'd lived through it. So, you know, I'd say watch the bond market, watch the price of gold, watch what the government's doing. I mean, they've signaled they're going to do yield curve control, which is effectively they more or less come out and said we've got to buy the bond market to keep interest rates down. The other thing they've kind of hinted at, and I wouldn't be surprised if they ultimately do it, is they've hinted that Congress maybe should give the Fed authority to buy the stock market and keep the stock market from declining, because so many people have the retirement savings in the stock market. If the stock market declines, it's going to make everything much worse. And so, and you know, Janet Yellen came out, she spoke about that on CNBC, and you know, to me, that was a big tell that they're definitely considering it. I mean, the Swiss central bank has done it. And it wouldn't surprise me at all if they decided to do it here, which is why it makes it very hard to short the U.S. stock market. I mean, and honestly, the biggest disconnect I see in the world right now is the stock market is within spitting distance of its old level, and yet, you know, we're looking at a 40% down GDP this quarter. So, I mean, go figure, right? I mean, and it was overvalued at its old level. So, you know, but I'm sure the people who are buying those stocks are thinking, well, what am I going to do? Buy a negative yielding bond? No. Put it into cash? No, that's getting debased. I mean, what really needs to happen is they need to wake up to the fact that the money is being severely debased, and that the way to protect oneself from that is to own physical silver, physical gold, and then you want to be more aggressive about that. And I mean, gold is the asset that Buffett says it's a goose that doesn't lay eggs because it just sits there and there's no productive use of gold other than storing value. And so if you want to be in a more productive investment, you would buy a gold miner or a silver miner because they take capital and they use it to produce gold out of the ground. And it just so happens that those companies are extraordinarily undervalued based on all historical metrics, such that they could double in price and still only be at the low end of the range of fair value. So, it's not beyond the realm of possibility, in my opinion, that we're going to have a 3 to 4 to 5x growth in gold stocks in the next 3 or 4 years, and potentially more. I mean, some of it will depend on what the gold price does. I mean, I can see a doubling in gold stocks with gold staying at $1,700, but I don't think gold's going to stay at $1,700. I think it's going to go through 19 sometime this year. And, then it's really going to be game on, because it'll be, all-time highs. That lights up a lot of the computers. I mean, a lot of share trading today is based on computer algorithms. And, they tend to chase stocks. I mean, the indexes especially tend to chase stocks that are hitting all-time highs. And then, of course, it becomes self-fulfilling. They hit another all-time high, they buy more. And so, gold will hit an all-time high at 1920 or so, at $1,920 an ounce. And what are we, we've been as high as 1765. So we're really close. I mean, it's not that much percentage-wise. And I think we'll get there pretty soon, and then it really gets fun. So it's an interesting time to be in this business. It's rather sad in terms of what's going on in the society, and it's sad in terms of how much people are going to suffer. I'm not rooting for any of that. I'm very much opposed to that. But the issue, I mean, and just as it was sad the way people suffered in the Great Depression, the problem is, Bernanke, the takeaway from the Great Depression for Bernanke was, well, we didn't do the right things, and therefore everyone suffered in the Great Depression. Well, no, that's an inaccurate view of it, in my opinion. What happened is they shouldn't have ever let the bubble build to begin with, because when you get a bubble, you're going to get a pop, and when it pops, somebody's going to get hurt. Period. End of story. So, the right thing to do is to have sound money and to not have a Federal Reserve, so that you're, building on a sound basis, and then you don't have these bubbles and bursts, and you don't have all the pain that's associated with the burst. But that doesn't really serve the politicians' needs to, seem powerful and get reelected and tell us what to do and so on and so forth. So, we've been condemned to a system that is the way it is, and given that that is the system, all I can do is try to protect myself and my family, my investors, from monetary debasement. And I'm pretty sure gold and silver mining stocks are the right way to go in this environment. My personal opinion is that everyone who has savings and is trying to protect themselves in this climate should start by owning physical gold, bullion, coins, bullion, whatever, in a format that they know is secure and that they can get at. Obviously, owning them in your own personal possession is great. There are things like, the bullionvault.com. I've got some there. There are ETFs that are safe, like, in my opinion, like Fizz, PHYS. I do not trust the ETF GLD, long story. But you start by owning physical. Then to the degree you want to try and have growth capital or speculative capital, then you can move over to the miners. And you start there probably with the royalty companies because they're the safest. They're expensive. They probably don't have quite as much upside, but they give you some more upside potential, I think, than the physical, because they're levered to the physical. Below that, you go into the majors because they have a lot of mines. Again, they're more expensive. They're not going to go up as much as the juniors, but they are going to go up with the price of gold. And then below that, the more aggressive place where you can maybe multiply your money is in the juniors, but be careful because they're very, very volatile, and you need to understand what you're doing. A good way to start is with the majors, with the index, GDXJ, and then start picking names. You can give your money to a fund manager who knows how to pick names. But even if you're going to pick names on your own, take whatever you're going to invest and divide it by 10, and pick 10 names, because I guarantee you, they're going to be names that totally blow up. But you look at it mathematically, and if you have one that goes down 1 and it goes up, and you have some others that go up 5x, it's going to work. But unfortunately, if you just pick the one and it goes down, you're going to really regret it. So make sure you spread your bets out across, at least 5 names and preferably 10. So that would be my advice to people who are looking at this area. Yeah, thank you very much, guys, for having me on the program. I always enjoy talking to resource investors. I do have an email, an email list that I put people on. I read a quarterly summary of what's going on. It's free, so I'm happy to do that. Anyone who sends me an email, I'll add them to the list. My email is my name. Well, it's LL, so 2 L's, and then my name, Lepard, Lepard. So Lepard at EMA, Edward Mark Alpha, the letters, the number 2.com. So EMA2.com. Send me an email, add you to my list, and you can see my commentary, which I put out every quarter. So.